Welcome to The Explainer. Today, we are breaking down a 60-year-old financial theory that is going to absolutely challenge everything you thought you knew about risk and return. We're talking about a concept that has been deeply misunderstood by everyday investors for decades. Yet, crazy enough, it forms the very bedrock of institutional finance. So, let's just dive right into this because it's a pretty wild hook. What if I told you that you could match the historical returns of a 100% equity portfolio, but with significantly smaller drawdowns? I know, it sounds like a total scam, right? Like the absolute holy grail of investing. All of the upside, way fewer sleepless nights. Well, while it might sound way too good to be true, the strategy we're unpacking today is actually entirely mathematically sound. And it all relies on one of the most polarizing concepts in all of finance: leverage.
Here is our roadmap for the analysis today. We're going to hit 5 key areas. First, the investment holy grail. Second, the math behind leverage. Third, the leverage aversion bias. Fourth, how to implement it. And finally, managing the real risks. Starting with part 1, the investment holy grail, unlocking efficiency. Now usually, if an investor wants higher returns, the go-to move is incredibly simple. Just pile all your money into 100% stocks. But according to modern portfolio theory, doing that actually creates a mathematically inefficient portfolio. You're basically overpaying in risk for every extra drop of return you get. And that brings us to our foundational metric for today, the Sharpe ratio. If you aren't familiar with it, the Sharpe ratio simply tells us how much extra return we're getting for every single unit of sleep-losing risk we take on. It is the ultimate measure of portfolio efficiency. So, to fix a low Sharpe ratio, academic theory says we shouldn't just buy more stocks. Instead, we should find a perfectly balanced, efficient portfolio, think of a 60-40 mix of stocks and bonds, and then apply leverage to it. To put this into perspective, let's look at some empirical data from Cliff Asness's groundbreaking research. Between 2002 and today, a 100% S&P 500 portfolio gave you an 11.31% annual return, but it came with nearly 19% volatility. Now compare that to a leveraged diversified 60-40 portfolio. That actually beat the S&P 500 with an 11.74% return, but it was significantly less volatile at 15.77%. The Sharpe ratio literally jumps from 0.57 to 0.68. You're actually getting more return for less risk.
Which brings us to part 2, the leverage aversion bias, why the market is wrong.
So you're probably wondering, if the math is so glaringly obvious here, why on earth isn't everyone doing this? Well, it comes down to 2 very different approaches. The flawed, super common approach is what retail investors and a lot of restricted funds do. They chase yield by just concentrating heavily in risky assets. They overpay for stocks purely because they're legally barred from, or honestly just terrified of, borrowing money. On the flip side, you have the mathematically optimal approach, which is what the big institutions use. They deeply diversify their assets to protect the downside, and then they carefully apply leverage to scale the returns up. The really crucial point here was perfectly captured in a fascinating 2012 research paper. Because the average investor is completely averse to leverage, literally treating it like it's financial dynamite, they artificially bid up the prices of high-risk assets like equities, which makes them expensive. And conversely, they ignore safer assets like bonds, making those cheap. This aversion to leverage isn't a rule, it's a psychological bias. It's a structural inefficiency in the market itself. The strategy we're talking about today simply exploits that exact human behavioral flaw. Let's move to part 3, how to implement it. Theory meets reality. Okay, so how do we actually pull this off without turning our life savings into a speculative casino? The magic number you need to remember here is 1.5x. According to all the foundational research, the academic sweet spot for target leverage is roughly 1.5 times. Basically, that means for every single dollar of your own capital, you have $1.50 of total market exposure. To give you an example, if you have a $100,000 portfolio, you're actually holding $90,000 in equities and $60,000 in bonds. It perfectly scales up your exposure efficiently without tipping you over into that extreme hyper-speculative territory. And there are generally 2 primary ways you can do this today. First, you've got a credit now Lombard approach, like the one offered by Fineco. This involves explicitly pledging your existing ETFs and bonds as collateral to get a cash line of credit. Now, this gives you incredible flexibility to build any portfolio you could possibly want, but you do pay explicit interest costs and you face very real margin call risks. Alternatively, you have all-in-one products like the WisdomTree NCSG ETF. This uses implicit, embedded leverage through bond futures. It is incredibly easy, literally just one click. But the catch is you are completely locked into their exact 90-60 ratio, and currently the fund has a relatively low amount of total money invested, otherwise known as assets under management.
Now, the absolute key to making that explicit borrowing method work is your cost of capital. If you borrow at 5% to make 6%, the math just totally falls apart. But promotional rates, like Fineco's specific Lombard credit spread, can be remarkably low. We're talking 0.10% to 0.25% over the Euribor rate, which is just a standard European benchmark interest rate. That is the kind of razor-thin borrowing margin that institutional investors rely on. When your borrowing costs are that close to the risk-free rate, the mathematical advantage of leveraging a diversified portfolio really starts to shine.
Let's get serious for part 4, managing the real risks, the double-edged sword.
Look, leverage is a remarkably sharp tool. It can build you a house, or it can easily cut your arm off. So let's objectively look at the 4 major ways this strategy can completely blow up in your face. Number 1 is mathematical. Just as leverage amplifies your gains, it viciously amplifies your drawdowns. Number 2 is the dreaded margin call. If the market drops and your collateral value shrinks, the bank can force you to liquidate assets at the absolute worst possible time. Number 3 is economic. If future market returns shrink and your borrowing costs rise, that sweet spread that makes this all work completely vanishes. And finally, number 4 is behavioral. Research shows time and time again that loss aversion feels twice as bad as the joy of gains. When your leveraged portfolio is bleeding red, the psychological urge to panic sell is overwhelming. When we look closely at the terrifying math of going to zero, the danger becomes super clear. At our recommended 1.5x leverage, your underlying portfolio would need to suffer a massive 67% drawdown to completely wipe out your capital. But look at what happens if you get a little greedy. At 3x leverage, a mere 33% market drop wipes you out completely. Think about that. You wouldn't have even survived the COVID crash. Game over. So, to avoid turning portfolio efficiency into reckless speculation, we can summarize our analysis with 3 concrete, totally non-negotiable rules. Step 1. Never, ever use leverage on a concentrated portfolio. You absolutely must use broad diversification across uncorrelated assets. Step 2. Never exceed a moderate leverage ratio. Keep it strictly between 1.2x and 1.5x maximum. And step 3. Never start this strategy without a pre-written, completely cold-blooded exit plan. You need to know exactly what you're going to do if a margin call hits long before the actual panic sets in.
I want to conclude this explainer by leaving you with one really provocative thought. Is your portfolio mathematically efficient, or is it just emotionally comfortable? Because as the data clearly shows, paying a premium to just avoid the discomfort of leverage might actually be the most expensive hidden fee in your entire financial life. Something to think about. Thanks for joining me on this deep dive, and as always, keep questioning the consensus.